said that we would continue asset purchases at this pace until we see substantial further progress. And that's actual progress, not forecast progress. So, and that's a difference from our past approach. So, and what we mean by that is pretty straightforward. It is we'll want to see that that the labor markets have moved, labor market conditions have moved, have made substantial progress toward maximum employment, and inflation has made substantial progress toward the 2% goal. That's what we're going to want to see. Now, that obviously includes an element of judgment. And when we see, we'll be carefully looking ahead. We also understand that we will want to provide as much advance notice of any potential taper as possible. So when we see that we're on track, when we see actual data coming in that suggests that we're on track to perhaps achieve substantial further progress, then we'll say so. And we'll say so well in advance of any decision to actually taper.
If I could follow up on that, the shift in the dots, why wouldn't that suggest a weakening of the commitment here? An awful lot of people shifted into 2022, it seems.
Yeah, I don't see that at all. We have a range of perspectives on the committee. I welcome that, and we debate things, we discuss things, and we always come together around a solution. But the strong bulk of the committee is not showing a rate increase during this forecast period. And as data improve, as the outlook improves very significantly since the December meeting, you would expect forecasts to move up. It's probably not a surprise that some people would bring in their estimate of the appropriate time for liftoff. Nonetheless, the bulk of the committee, the largest part by far of the committee, doesn't show a rate increase during this period. And again, part of that is wanting to see actual data rather than just a forecast at this point. We do expect that we'll begin to make faster progress on both spending, labor markets and inflation as the year goes on because of the progress with the vaccines, because of the fiscal support that we're getting. We expect that to happen, but we'll have to see it first.
Great, thank you. Victoria.
Hi, Chair Powell. I wanted to ask about the supplementary leverage ratio. There's been a lot of talk about what you all are going to do this month, which I'm happy to hear an update if you have one. But just sort of more broadly, do you think long term that the leverage ratio poses problems for implementing monetary policy at a time when the reserve supply is going to remain large? And if so, do you think that changes to the leverage ratio, including the SLR, are the way to deal with that problem?
Victoria, we'll have something to announce on that in coming days, and I'm not going to expound upon your questions. Why don't you ask another question if you'd like to, because that one I'm just going to say that we're something in coming days.
Sure. Okay. Well, then I'll ask about unemployment. There's the unemployment rate is you all have projections for the U6 rate, but you've also been, really emphasizing the fact that that's not the only thing that you all are looking at. You're also looking at labor force participation and things like that. So are you all looking at ways of maybe adding to how you're projecting the unemployment rate to the summary of economic projections?
Well, let me say, as we say in our statement on longer run goals and monetary policy strategy, we look to a range of indicators on labor market. We never only looked at the unemployment rate, which is the only indicator of labor market outcomes that's in the SEP. We look at a very broad range. You hear us talk all the time about participation, about employment to population, which is the combination of the two, about different measures of unemployment. So it's wages, it's the job flows, it's all of those things they go into an assessment, disparities of various groups. All that goes into an assessment of maximum employment. The trying to incorporate all of that into the summary of economic projections would not be practical. Obviously the thing that we do include is just the unemployment rate, and that's a very insufficient statistic. So it doesn't include a lot of other things that we do look at. And I wouldn't want to say that we're looking to include the other dozen things that we look at into the SEP, but from time to time we do look at adding different things. But I would just say the SEP it's a summary. It's one device. It's not going to include all of the things that we look at. I think you know the things that we look at. We talk about them all the time. So we're not actually looking actively at significantly broadening those indicators in the SEP right now.
Thank you. Chris Rugaber, Associated Press.
Thank you. Chair Powell, I wanted to ask about the forecast overall. You're forecasting a very low unemployment rate next year, and in 2023, you have inflation, or the Fed overall is in the SEP forecasting inflation at or above 2% by 2023. Yet no rate hike in any of this forecast horizon. So is this telling us that you see a higher inflation rate than what's projected, or do you not? As you've been talking about, is the unemployment rate insufficient, or what is this telling us about the Fed's reaction function? That it seems you're meeting the Fed's dual mandate by 2023, yet again, no rate hike expected.
So I guess the first thing to say is that the SEP is not a committee forecast. It's not something we sit around and debate and discuss and approve and say this represents our reaction function as a committee. It's a compilation of projections from different people, and but since we don't debate it or discuss it, it would be hard for me to say exactly why each participant did what they were going to do. So all I would say about this is that we've laid out what I think is very clear guidance on liftoff. And it's really three things: labor market conditions that are consistent with our estimates of maximum employment. And as I mentioned, we consider a wide range of indicators in assessing labor market conditions, not just the unemployment rate. Inflation that has reached 2% and not just on a transitory basis. And inflation that's on track to run moderately above 2% for some time. The first two of those three are very much data-based. The third does have a little bit of an element of expectations in it. So we are very much determined to implement this guidance in a robust way. It is the guidance that we chose carefully to implement our new framework. And to meet these standards, we'll need to see data, as I mentioned. So what does this SEP really say? It says that we're committed to our framework and to the guidance we've provided to implement that framework. We will wait until the requirements set forth in that guidance are clearly met before considering a change in our policy rate. And the last thing I'll say is this. The state of the economy in 2 or 3 years is highly uncertain, and I wouldn't want to focus too much on the exact timing of a potential rate increase that far into the future. So that's how I would think about the SEP.
Thank you. Paul Kiernan.
Thank you, Chairman Powell. My question is twofold. One, how high are you comfortable letting inflation rise? There is some ambiguity in your new target, as you mentioned, expectations driven. And do you think that ambiguity might cause markets to price in a lower tolerance for inflation than the Fed actually has, thereby causing financial conditions to tighten prematurely? Is that a concern? Thanks.
So we've said we'd like to see inflation run moderately above 2% for some time. And we've resisted, basically, generally, the temptation to try to quantify that. Part of that just is talking about inflation is one thing. Actually having inflation run above 2% is the real thing. So over the years, we've talked about 2% inflation as a goal, but we haven't achieved it. So I would say we'd like to, perform. That's what we'd really like to do, is to get inflation moderately above 2%. I don't want to be too specific about what that means because I think it's hard to do that. And we haven't done it yet. When we're actually above 2%, we can do that. Look, I would say this. The fundamental change in our framework is that we're not going to act preemptively based on forecasts for the most part. And we're going to wait to see actual data. And I think it will take people time to adjust to that and to adjust to that new practice. And the only way we can really build the credibility of that is by doing it. So that's how I would think about that.
Thank you. Matthew Bosler.
Hi, Chair Powell. This is Matthew Boser with Bloomberg News. So there's a widespread presumption at this point that the U.S. will reach herd immunity sometime this year. And all along, you've said that the path of the economy is going to be determined by the course of the virus. I'm curious, based on the projections that you released today that show unemployment will still be above estimates of maximum employment through the end of next year and perhaps sometime into 2023, do you think policymakers need to be doing more here to sort of align the herd immunity and full employment timelines, if you will? Thank you.
So on herd immunity, I'm really going to leave that question to the experts. We don't control that. We're not responsible for defining it. We'll leave that whole discussion to the experts. I mean, what we're focused on is the part that we control, which is the support that we provide to the economy. And there we provided very clear guidance. And in the case of asset purchases, it's at their current level until we make substantial further progress. There is an element of judgment in that, and we'll supply clear communication well in advance of actually tapering. And we just went through the criteria for raising interest rates. They're very specific, and we're very much committed to having them fulfilled robustly. I would agree with you that the path of the virus continues to be very important. We have these new strains which can be quite virulent, and we're not actually done yet. And we're clearly on a good path with cases coming down, as I mentioned, but we're not done. And I'd hate to see us take our eye off the ball before we actually finish the job. So that's how I would look at that.
If I could just briefly follow up, how do you see sort of the disconnect in terms of an economy that is expected to be widely reopened this year, but full employment taking longer to achieve? Is it the case that factors related to the virus will still be with us over the coming years? Is that how to interpret the forecasts?
I think there's some of that. Sure, there'll be some of that. There'll still be some social distancing. People may be, for example, going into spaces that involve close contact with others. Some people will do that right away. Others will hold back, and so I think there'll be some of that. In addition, though, remember there are 10 million people in the range of 10 million people who need to get back to work, and it's going to take some time for that to happen. It can happen. Maybe more quickly than it has in the past because it involves the reopening of a sector of the economy as opposed to stimulating aggregate demand and waiting for that to produce job demand for workers. This could be a different sort of a process, and it could be quicker. We don't know that. But it's just a lot of people who need to get back to work, and it's not going to happen overnight. It's going to take some time, no matter how well the economy performs. Unemployment will take quite a time to go down, and so will participation. So that's all I can say. I think the faster the better. We'd love to see it come sooner rather than later. We'd welcome nothing more than that. But realistically, given the numbers, it's going to take some time.
Thank you. Steve Leisman.
Mr. Chairman, thank you. I wonder if you could, kind of a three-parter here, but all related. Would you comment on the current level of the 10-year yield and some other long rates out there, whether or not you think they would have a negative effect on the economy? And if not, is there a level that would give you concern? And finally, the third part, other central bankers have expressed concern about what's happened to yields in their countries, and even some taken action, but not you. Could you give us your general idea or orientation towards the idea of coming into the market and affecting a particular tenor of the bond market? Do you like that idea? Do you not like it? Is it at the top of your toolbox, or is it something that you think is at the bottom of the toolbox?
Sure. So we monitor a broad range of financial conditions, and we're always attentive to market developments, of course. We're still a long way from our goals, and it's important that financial conditions do remain accommodative to support the achievement of those goals. And if you look at various indexes of financial conditions, what you'll see is that they generally do show financial conditions overall to be highly accommodative, and that is appropriate. So that's how we look at it. I would add, as I've said, I would be concerned by disorderly conditions in markets or by a persistent tightening of financial conditions that threaten the achievement of our goals. We think the stance of monetary policy remains appropriate. Our guidance on the federal funds rate and on asset purchases is providing strong support for the economy, and we're committed to maintaining that patiently accommodative stance until the job is well and truly done.
Could you give us an idea of how you sort of feel about that tool of being able to come into a particular part of the market and either doing an operation twist or something like that? Is that something you feel to be the top of your toolbox or something that you don't really prefer?
You know, the tools we have are the tools we have. What I'm telling you is that the stance of monetary policy we have today, we believe is appropriate. We think that our asset purchases in their current form, which is to say, you know, across the curve, 80 billion in treasuries, 40 billion in mortgage-backed securities on net. We think that that's the right place for our asset purchases. Now we can change them, of course, in a number of different dimensions should we deem that that's appropriate. But for now, we think that our policy stance on that is appropriate.
Thank you. Rachel Siegel.
Hi, Chair Powell. Thanks very much for taking my question. You've spoken about the pandemic's disproportionate toll on Black Americans, Hispanic Americans, Asian Americans, and other groups in the labor market. And I'm curious if you can speak to specific indicators that the Fed will be using to measure job gains for groups that have persistently higher rates of unemployment compared to white Americans. And relatedly, since you've described vaccines as key to the economic recovery, is the Fed concerned about lower vaccination rates in communities of color, and what barriers do you think exist there? Thanks very much.
So which measures? So we do monitor and communicate very regularly about different labor market disparities in the labor market, let's say. So the African American unemployment rate is substantially elevated, and so is the Hispanic unemployment rate. So we look at those and we see those as, you know, it's slack in the labor market. It's sad to see because those disparities had really come down to record lows since we started keeping the data that way. As recently as a year ago, February of last year, we had those disparities quite low. What happens in a downturn, though, is they move up at twice the speed of white unemployment. So we monitor those things. Our tools, of course, affect unemployment generally, but we're going to look at those as a form of slack in the labor market and hope that that there's progress there. And this particular downturn, of course, was just a direct hit on a part of the economy that employs many minorities and lower paid workers. The public-facing workers in the service industries, in many cases, don't have a lot of financial assets. They're not tremendously well paid. They might have other jobs and things like that. So this was a direct hit on that part of the economy, and it's the slowest part of the economy to recover. So, we like to see those people continue to get supported, as the broader economy recovers, which is very much doing now. In terms of disparate levels of vaccination, those are facts, unfortunate facts. They're really not something we have within our policy toolkit to address, but it is true, though, that the data we have suggests that there are significant disparities between different ethnic groups, and but that's not for us. That's for fiscal authorities and the government more generally to work on.
Thank you. Gina Smialek.
Hey, Chair Powell. Thanks for taking our questions. I was wondering if you could talk a little bit about how you see the fiscal policy support that has come down the line affecting the economy's potential in the longer term, just in the sense that you've talked a lot about the potential for labor market scarring and how that might weigh on our sort of future prospects. And I wonder whether you see that sort of working in reverse. If we pull people back into the labor market more quickly, does that improve our chances?
So I do think that fiscal policy overall will have really helped us to avoid much of the scarring that we were very, very concerned about at the beginning. And I think that's just the size and the speed with which Congress has delivered, with the CARES Act and since then, is going to wind up very much accelerating the return to full employment. It's going to make a huge difference in people's lives, and it has already. As I mentioned in my opening remarks, the recovery has been faster than we expected. Part of that just is very hard to predict, given we've never seen an event like this. But part of it is just the strength of the fiscal response, which I think will look good over the years. Longer term, to really, the first part of it is about avoiding scarring, and I think we've not avoided all of the scarring, but we've probably avoided the worst cases there. And I hope we keep at it, and we will keep at it with our policies, of course, to do whatever we can to make sure that continues. Longer term, though, what it takes to drive productive capacity per capita or per hour worked to raise living standards over time is investment in people's skills and aptitudes, investment in plant and equipment, investment in software. It takes a lot of investment to support a more productive economy and raise living standards. And that's, that hasn't been the principal focus with these measures, our measures certainly, and we don't have those tools, but what Congress has been doing has mainly been replacing lost income and beginning to, support people as the economy returns to normal. But there should be a focus on, a longer term focus, I think, would be healthy on the investment front.
Thank you. James Politi.
Thank you, Chair Powell. I wanted to ask a question about the Eurozone. While the outlook for the US economy has much improved, progress in the Eurozone has been far less encouraging, and it's showing signs of serious weakness due to the slower vaccination rollout and renewed lockdowns and restrictions. How worried are you about transatlantic economic divergence and the possibility that trouble in the Eurozone and weakness in the Eurozone could drag down the U.S. recovery, as it did in a way in the aftermath of the financial crisis?
You're right. The pace of the recovery is, we're having diverging recoveries here, as we did after the last crisis. And in this case, as well as the other one, the U.S.'s recovery is leading the global recovery. And we conduct policy, of course, here. Our focus is on our objectives are domestic ones. It's maximum employment and price stability here in the United States. We monitor developments abroad, and we know that because we know that those can affect our outcomes. So I think U.S. demand, very strong U.S. demand, if as the economy improves, is going to support global activity as well over time. That'll be through imports, and when the U.S. economy is strong, that strength tends to support global activity as well. So that's one thing. I don't worry in the near term. I'd love to see Europe growing faster. I'd love to see the vaccine rollout going more smoothly. But I don't worry too much about us in the near term because we're on a very good track. Very strong fiscal support coming. Now vaccination going quickly, and cases coming down. I think we're in a good place. It's all ahead of us, but the data should get stronger fairly quickly here and remain strong for some time here.
Thank you. Hannah Lang.
Hi, thanks so much for taking our questions. I wanted to ask if the Fed is planning on extending the same restrictions on bank dividends and share repurchases that are currently in place into the second quarter, and if you're considering at all the scenario analysis and mid-cycle stress tests that were in place last year, this year, and kind of what would make you consider doing something like that again.
So we haven't made a decision on that. We're a couple weeks away from announcing that decision. I won't foreshadow it here today. I will say we're going to continue our data-driven approach. You know that we restricted buybacks and dividends, so the firms are preserving capital. Through 2020, the banks actually increased their level of capital and their level of reserves. And the December stress tests showed that banks are strong and well capitalized under our hypothetical recessions that we used in December, which were quite stringent. We're right in the middle of our 2021 stress test, and we'll release those results before the end of June, and that layers, very significant additional stress on top of the stress the banks have already absorbed over the past year, with the unemployment rate going to 11% and stock prices falling more than 50%. So, but all of that, the results of the stress test and the decision on distributions, all of that is to come fairly soon.
Thanks for watching, and if you haven't already, please consider subscribing to our channel. And while you're at it, please leave us a comment. Thank you for watching.